How about a cool idea for today's crazy market? As I've said many times before, giving you great ideas is what sets us apart. So if you're patient and take some notes, I think you'll like this one. It's called a Jade Lizard Hybrid. That alone should keep you focused on staying with us for a little bit. Hi, this is Dave Duley from the Georgia Advisor Group here in Alpharetta, Georgia, with over 40 years in the financial markets and some of the brightest minds when it comes to taking advantage of solid strategies in today's market. We try to provide timely financial tips to help our followers be more aware and knowledgeable in today's complex and ever-changing economic times. For the year 2022, the Dow Jones is down around 21%. The S&P 500 is down 25%, and the Nasdaq is down over 33%, and that's just year to date. Not their highs from late 2021. Those numbers are enough to force a lot of people to run and hide, but we continue to look for ways to not only survive but to thrive. Normally our videos are an overview in nature, more informative than strategic, but today we wanted to throw just a little idea out there that may be timely for today's market. One could make a case for high inflation and high interest rates continuing to put pressure on the markets. One could also make a case for certain profitable companies that have had a decent drop to be ready to go up soon. And lastly, one could make a case for a little sideways action for the foreseeable future, at least until the interest rates and inflation situation starts calming down. So, is there any strategy we could use that would give us a chance to either make decent money in a sideways or up market and be able to buy some really good stocks 20% below the market if we continue down for a while longer? The answer to that is yes, there is. Now, before I lay out this strategy, you must know this is a stock and option combination, and it generates exceptional amount of income. I need to mention, even if you love this type of trade, do not run out and put this trade on without making sure you are fully knowledgeable on the details of this strategy. Options are much like power tools. If you know how to handle them and you're careful, they can be great assets to you. But if you don't know how to handle them and you're careless, you can get hurt. If you like the concept but want to know more details, seek out an expert or contact us directly. So if you have a pen and paper, let's get started. The first part is to select a stock that you would love to own and be willing to hold it for at least a year. For purposes of this video, we will use Apple, and I'm using numbers that are today's numbers, not when this video is posted, which will probably be about a week from now. But the application still remains the same. Determine how many shares you would like to potentially own. It should be at least 200 shares. Now, our first transaction is to buy 100 shares, and today's price on Apple is $139. So we invest $13,900. Our next trade is to sell 1 June 2023 150 call option for $12 per share, which produces $1,200 to you. That's yours to keep. This trade means that you're agreeing to sell your 100 shares for $150 per share if it rises to $150 or higher. The final trade is to sell 1 June 2023 130 put option for $10 a share, which produces another $1,000 to you that's yours to keep. This trade means that you're agreeing to buy 100 more shares for $130 per share if it drops to $130 or lower. Now, what does all this really mean? It means that you take in a total of $2,200 by selling the options. This is 15.8% of the value of the stock. If the stock rises to above 150 by next June and you are forced to sell it for 150, you add 11 per share or 1,000 more profit to your 2,200 or 3,300 and 23% total return. This is your best and maximum profit no matter how high Apple should rise in the future. But that return is yours with a minimum amount of movement. This is a very good return in approximately 8 months with not much movement required. Now, what is our risk? We stated at the beginning that we wouldn't mind owning 200 shares, and so far we've only bought 100 shares. If the stock should drop below 130, we will have to buy another 100 at 130, even if it drops below that. So how does that look upon selling the options up front? We received 2,200 That's ours to keep. If we were required to buy 100 more shares at 130, we would be investing another $13,000 or a total of $26,900 for the 200 shares that we've now bought. As we already received 2,200, that will reduce our total expenditure to $24,450 or a cost basis or break-even price of $123.25. That's $16.75 below today's market price. We would not have losses unless it dropped below $123.25. So our potential outcomes under $130, our break-even point is $123.25. Between $140 and $150, our gain is 15.8%. And above 150, our return is around 23%. Not bad for 8 months. So a great idea with companies that are fundamentally strong, with great management in place, and most importantly, stay with a reasonable, stay and trade within a reasonable range. Now, don't get frustrated as you stop this video or as you're looking at it, because you can stop it and start it and go back and review what I've just talked about. As always, though, I'm going to tell you, use experts in these areas. Most firms don't have the time or resources to provide this type of service. But with a boutique firm like ours, these are what actively managed accounts look like. Now, I hope this gets you thinking a little bit. And if you think our content is good, I want you to click subscribe below. Click on the Show More button also. And that way you'll be able to visit us at our website and take a look around and be able to fill out the information there to join our newsletter. Till next time.